Em nhớ đồng bạn nó ghi âm lại được không?
Be able to see you all as well. No copying, no choking, exam conditions. Question 1. A weakness of break-even analysis is that it assumes 1, for A, revenue and costs are linear. Revenue and costs are linear function of volume, or prices and costs increase when the economy is strong and confidence is high. Which is true? A weakness of break-even analysis is that it assumes that revenues and costs are a linear function of volume. That's A. And B answer is prices and costs increase when the economy is strong and confidence is high. Don't choose something that sounds right, just choose something which answers the question. A weakness is that a weakness of break-even analysis. Question number 2. A conservative financing plan. I'll tell you what conservative means, just so as you learn a bit of English. Conservative means a careful, cautious approach. You know what cautious means? Sort of a risk-averse. Okay? A conservative financing plan involves, number 1, a heavy reliance on debt, or B, a heavy reliance on equity. A heavy reliance on debt or a heavy reliance on equity. Question number, I've just skipped a question because the correct answer is all of the above. So I'm not going to ask you that one. The next question, a normal term structure of interest rates. A normal term structure of interest rates would show that short-term rates are higher than long-term rates, A, or B, long-term rates are higher than short-term rates. Normal term structure of interest rates. Think of it in your mind. Short-term, you can draw it on your piece of paper if you want. Short-term rates are higher than long-term rates, or B, long-term rates are higher than short-term rates. What is normal? We've discussed that. I asked people to explain to me why, so everybody knows that. The next bunch of questions in the exam are all about working capital management, which Ms. Vaya spent 3 weeks talking about. We're going to spend 3 hours next week. B. Okay, next question. Should be question 4. Is it question 4 for you?
Yes.
I can see some people who haven't even answered anything yet. Okay. The valuation of financial assets requires knowledge of A, future cash flows, or B, past asset performance. Valuation of financial assets requires the knowledge of future cash flows or past performance. Okay, next question. In a general sense, the value of an asset is A, the present value of the cash flows received from the asset, present value of the cash flows received from the asset, or the future value of the expected earnings discounted by the asset's cost of capital. In a general sense, present value of the cash flows received from the asset, or the future value of the expected earnings in a general sense. Okay? All right. Next question. Easy one. In the relationship between a bond's price and the yield to maturity, A is an inverse relationship, or B is a linear relationship.
Can you repeat the answer?
Yeah, the relationship between the bond price and the yield to maturity of the bond is A, an inverse relationship, or a linear relationship. You know the difference between an inverse relationship and a linear relationship? An inverse relationship means they go in opposite directions. A linear relationship means they go in the same direction. If there's a linear relationship, for example, between growth and inflation. There tends to be an inverse relationship between unemployment and growth. Unemployment tends to go up when growth goes down, and unemployment tends to go down when growth goes up. So in a bond, the relationship between the price and the yield to maturity, is it a linear or an inverse relationship? Answer A for inverse and B for linear. Okay, question number 7 is the dividend valuation model of stocks. The dividend valuation model of stocks, which you did in corporate finance. It stresses, it puts a lot of importance on either the importance of dividends and legal rules for maximum payment, or B, on the relationship of dividends to market prices. The dividend model stresses either A, the importance of dividends and legal rules for maximum payment of dividends, or B, the relationship of dividends to market prices. Question number 8. Also on stock valuation models. Stock valuation models are dependent on A, expected dividends, future dividend growth, and an appropriate discount rate, or B, past dividends, flotation cost, and bond yields. A stock valuation model is dependent on A, expected dividends, future dividend growth, and appropriate discount rate, or is the model dependent on past dividends, flotation costs, and bond yields? Very easy. Okay, you have to listen carefully to these questions. I mean, in a way it's more difficult in the exam because you've got four choices to think about, but it's easier in the exam because you can read it and read it again, and read it a third time if you have enough time, or just eliminate those which are wrong and you're left with something which looks maybe right. Can't do that here. But anyway, here's the next question. The overall weighted average cost of capital, WACC, is used instead of costs for specific sources of funds. What does that mean? We use WACC, the weighted average, rather than the cost of debt or the cost of equity when we're evaluating projects. So we use the overall weighted cost of both debt and equity because either A, the use of the cost of specific sources, the cost for debt and the cost of capital for debt and the cost for equity, if you use those different interest rates for debt and the cost of equity, it would make inconsistent investment decisions. That's answer A. Or the answer B was the overall WACC is used, in practice we use the overall cost of capital, we don't break it down into the cost of debt and the cost of equity. We use the overall weight because a project with the highest return would always be accepted under this specific cost criteria. But you have to ask yourself, does that make sense? Or does the first one make sense? A or B? Yeah. Because a project with the highest return would always be accepted under the specific costing criteria. Okay, I have to keep moving because I want to review these questions, and that will take some time too. But I want you to understand these things, not just A's and B's, but why are the answers right as opposed to the other one being wrong. pre-tax cost of debt for a new issue by a company. New issue, a company's got some debt already in its balance sheet. It's going to issue a new bond. Pre-tax cost of debt is determined by the what? Either the coupon rate of interest on existing debt, or the yield to maturity of comparable outstanding bonds. Yield to maturity of comparable outstanding bonds. We had some discussion of this before, but I want to go over it one more time later. Okay. Next question. Is this question number 11? That we're coming up to now? I'm juggling these around as I move. Okay. Although debt financing is usually the cheapest component, the cheapest part of capital, it cannot be used in excess. You can't use too much of it because either what? Because interest rates may change, or the financial risk of the firm may increase and thus drive up the cost of all sources of financing, both debt and equity. That's B. So let me repeat the question. Although debt financing, bonds, is usually the cheapest component or part of capital, it cannot be used in excess. You can't borrow too much because either interest rates may change, answer A, or answer B, financial risk of the firm may increase and drive up the cost of all source of financing. If you think about it, it's pretty obvious what the answer to that question is. Capital budgeting, which we started talking about last week. Capital budgeting is primarily concerned with A, capital formation in the economy, or B, evaluating investment alternatives. Capital budgeting is mainly concerned with capital formation in the economy, or B, evaluating investment alternatives. Okay, next question. Which of the following statements about payback method? Which of the following statements about, I hope you two are not sharing answers, by the way. You seem to be talking a lot together. Which of the following statements about the payback method is true? Payback method. We had an example of payback method last time. Answer A would be that the payback method considers cash flows after the payback has been reached? Or answer B, the payback method does not consider the time value of money. The question was, which of the following statements is true? First one says, payback method considers cash flows after payback. And the second answer, B, says the payback method does not consider the time value of money. Is it A or B? I sound like one of those quizmasters on television. I'm not so well paid as they are. Okay, next question, number 14. If projects are mutually exclusive, remember we talked about mutually exclusive, either the selection of one alternative precludes, that means prevents, the selection of another alternative, that's answer A, or an alternative answer would be, if projects are mutually exclusive, the payback method should be used. That would be answer B. Okay, question number 15, sorry. I dropped one, didn't I? A characteristic of capital budgeting, which is when you're doing all these net present values and choosing projects. If you've forgotten what capital budgeting is all about. The characteristic of capital budgeting is answer A, that the internal rate of return, the IRR, the internal rate of return must be greater than the cost of capital. The characteristic of capital budgeting, that's answer number A. And answer number B would be the internal rate of return must be less than the cost of capital. Characteristic of capital budgeting is either the internal rate of return must be greater than the cost of capital, or B, the internal rate of return must be less than the cost of capital. Again, that should be completely obvious to anybody who understands the first word about what I've been talking about for 3 weeks or 4 weeks or 5 weeks or 6 weeks. With non-mutually, next question, with non-mutually exclusive projects, in other words, you can do more than one.
Non-mutually exclusive.
Answer A, the net present value is not acceptable. Or answer B, I'm changing the letters around here so that you won't remember it for the exam. Answer B, the net present value and the internal rate of return methods, remember we had 2 different types of evaluating whether a project was acceptable or not. But with non-mutually exclusive projects, the net present value and the internal rate of return method will accept or reject the same project. You get the same yes or no answer, whether or not you use NPV or IRR. That's the second alternative answer, B. Okay, question number 17. Remember, you've got 40 questions in the midterm. I'll have given you about 20 of them already, more or less, with some slight changes like not, or is not. But the same subject area. Okay, the NPV method, the net present value, is a more conservative technique, a more careful, we used that word conservative before, a more careful, less aggressive technique. Is a more conservative technique for selecting investment projects, more conservative than the IRR method, because the NPV method assumes cash flows are reinvested at the firm's weighted average cost of capital. Right or wrong? The NPV method is better at selecting projects than the IRR method because the NPV method assumes cash flows are reinvested at the firm's weighted average cost of capital. Is that right or wrong? A is right, B is wrong. Okay. Question number 18, still on projects. If an investment project has a positive net present value, then the internal rate of return is greater than the cost of capital or less than the cost of capital. Similar to a question I asked before, but not exactly the same. If an investment project has a positive NPV, then the internal rate of return is greater than the cost of capital or less than the cost of capital. Okay. Question number 19. I like this one. Risk is usually measured as, not standard limit, is usually measured as the A, variability of outcomes around some expected value, or B, the probability of expected values. Risk is usually measured as the variability of outcomes around some expected value, like the mean, or B, the probability of expected values, A or B. Probability of expected values is answer B. The variability of outcomes around some expected value is the other possible correct answer. And I need to add in one more question because I dropped one earlier on. Okay, so question 20. something that I think we've talked about. I'm not absolutely sure. But it refers to something we talked about, I think, when we looked at the risk. I think we said that there were two ways, basically, of managing risk. One was through diversification, and one was through hedging. So here you're asked to explain what hedging means. So here are two possible definitions of hedging. Hedging refers to a transaction that reduces risk exposure or does it mean avoiding the financial futures markets? A or B? Hedging refers to a transaction that reduces risk exposure. Are you not even bothering to answer the questions? Or B, avoiding the financial futures market. Okay, let's go through quickly the answers. And I'll try and explain them if I can remember what the alternative answers were. Okay. Question 1 was on break-even analysis. Break-even. When does this project break even? And one of the weaknesses is answer A. Revenue and costs are a linear function of volume. They're not, you're just dividing the cost by the number of years. Or you're dividing the number of the revenues by that will pay back the cost. You spend $1 million, you make 200,000 every year, you could say the break even is in 5 years. But that's just linear arithmetic, isn't it? It's not taking count of discounting or different values at different times. There's no time value of money involved in that. So answer A is correct. Question number 1. Question number 2. Conservative financing plan involves heavy reliance on debt or heavy reliance on equity. The answer is equity B. Conservative financing plan. The opposite of conservative is risky. Debt is more risky to finance with. It's cheaper, but it's risky. Because if you're borrowing and you don't pay interest, then the people who own the bond can make you go bankrupt. If you're borrowing and you don't pay a dividend from the shareholders, and you don't pay a dividend, the shareholders are you. You own the company. And you're not going to try and make yourself go bankrupt. You're just going to not pay the dividend. Okay? That's why debt is more risky than equity. Anyway, correct answer was B. I think I skipped what was the old question 3. So the new question 3 is a normal term structure of interest rates shows long-term rates higher than short-term rates. That was answer number B. Short-term rates higher than long-term rates is not normal. You remember I drew the normal interest curve before. I called it even, what do they call that curve? What's it called? Long-term, short-term, I goes higher as you go longer, right? There's a risk premium. Generally speaking, the higher, the longer you lend something to somebody, the higher the risk. When you're investing, you're lending the money. When you buy a bond, you're lending the money. You want to be compensated. I want to know, I might lend you $1 million for a week. I don't think I'd lend you $10 million for a year. You might not be here, I might not be here. Yes? Okay. How many people got that right? Long-term rates higher than short-term rates? That's normal. Answer B. Actually, what I haven't done is the following. You're marking your own papers, aren't you? Okay, now you have to swap your papers with somebody else. I've only done three questions, so it's not that I don't trust you, it's just that I don't trust you. Okay, you have to pass it backwards and forwards, not side to side, but not somebody sitting next to you, but somebody in front of you. Okay, come on. So we just did the question on the yield curve. I can guarantee you there are questions on this very same subject in the midterm. So if you pay attention, even to what you got wrong on it, understand why you didn't get it right is probably most important. Because a lot of these are actually very, when you think about it, are very common sense. Questions? Okay. Question number 4. Correct answer A. Future cash flows. The valuation of financial assets requires knowledge of future cash flows. The alternative was B. Was past asset performance. That's not a guide to the future, is it? Why are you interested in the past? The whole message, the whole thing you have to understand about capital budgeting and capital investment is future, it's your future. My past is irrelevant. Your future is what's important. Future cash flows. Bringing them back and giving them a present value. The future values of all assets, stocks, bonds, are based on the present. The price is dependent on the future cash flows. Maybe dividends, it may be the growth of the stock price, the capital gain that you make from selling it at a higher price in the future, which is not guaranteed, which is more risky. At least with a bond, nearly all the time they get repaid. In 10 years' time, you get your money back. In the middle of it, you've been getting, you've been making regular interest And most people actually, most professionals, never hold the bond until maturity. They try and take a capital gain when the prices go up. When do the prices go up? When the yields go. That is what's called a inverse relationship, isn't it? One goes up, the other goes down. We'll get back to that question later. So, question number 4A. Question number 5. I can't remember what I gave as A and B. Okay, I think it is A, which is the value of the asset is the present value of the cash flows received from the asset. I think the alternative was the value of past dividends and price increases from the asset. Oh no, it was. B was another wrong answer, which the future value of the expected earnings discounted by the asset's cost of capital. It's a present value I want, not a future value. So the correct answer is A. On my sheet is B, that's why it's confusing. You get that? You all got that? Good. Remember, you're marking somebody else's paper now. It should be easier to be ruthless. Okay. 24. Sorry, that's 24 in the test. Question number 6. The correct answer is A. The relationship between a bond's price and the yield to maturity is an inverse relationship. Inverse. The other answer B, linear relationship, is wrong. When interest rates go up, bond prices go down. If it was a linear relationship, then interest rates go up, then prices would somehow also go up. That may be the case with a car. Prices go up when interest rates go up, but not with bonds. Question 6, then, correct answer A. Question number 7, correct answer is B. The dividend valuation model stresses the relationship of dividends to market prices. Did you get that right? She wants to know. B was the correct answer. The wrong answer, A, was I gave up the importance of dividends and legal rules for the maximum payment. I mean, that's gibberish, that's nonsense, that's trash talk. It means nothing. When you see an answer that is complete nonsense, then you can rule it out. And some of these answers are complete nonsense, I have to tell you. Sometimes I've tried to choose something which could be right. Question number 8. Have we got to 8 yet? 8? Not yet? You have the answer to question number 8 yet from me? No. The correct answer is A. Stock valuation models are dependent on expected dividends, future dividend growth, and appropriate discount rate. I'm not going to go through the wrong answers. I'm just going to go with the right answers from now on. Question number 9. The correct answer is A. That means, I should explain why what A was, because it will go in the midterm. This is a midterm paper I'm reading from.
it?
No. The overall weighted average cost of capital, WACC. We have a weight for debt and a weight for equity. Remember that. That's why they call it weighted average. In the book and in the slides and everything, they show 3 weights, don't they? The weight for common stock, a weight for preferred stock, and a weight for debt. I decided to cut out preferred stock because preferred stock is very, very unusual in this country. So if you use the cost of debt for discounting one project and the cost of equity for discounting another, then you're going to make one less attractive. Which one will you make less attractive? The net present value term. If you have one project and you say, okay, we're going to fund that with debt, with a bond. So we'll discount the value of that project at the yield to maturity of the bond. And we've got another project that we're going to not have enough borrowings for. We're going to fund that with equity. Which one is going to have the lowest net present value and therefore be the least attractive project? You need to use a bit of logic here. Okay, let me walk you through it step by step. Here was my question. Which of those 2 projects? One's going to be funded with debt, and you decide you'll discount that at the cost of debt. And one's going to be funded with equity, and you're going to discount that with the cost of equity. Which is the higher cost, debt or equity? We've been through this many times, right? I don't know why you're all hesitating. Which is the cheapest way of funding a company? Debt or equity?
Debt.
Debt. Okay. So that means which is the most expensive way of funding a company is with equity. Right. That was the answer to my question, wasn't it? Okay. So if you're using the cost of, so what you've said now, I think, you're struggling, but you got there. The cost of equity is generally higher than the cost of debt. And the reason for that is generally it's riskier. Why? Because it's forever. Yes? Look at it, when I say risk, look at it from the point of view of the, first of all, of the investor. Stock is riskier than bonds, isn't it? Because bonds mature, you get your money back. And if the interest isn't paid, you can force the company to liquidate its assets, sell off its buildings to pay you back. If you're a shareholder, you own it, you can't force it to stop. Debt is less risky than equity for an investor. And that's why, generally speaking, investors expect a higher rate of return, don't they, when they're investing in stocks? They say, why would I invest in that stock, which is going to give me maybe 10% returns next year, or 20%, 15% returns next year? Why would I invest in that stock if the bond is going to give me more? The bond is less risky, I'll get my money back. What is the incentive in me risking my money in that company, stupid company, that they don't have to pay me a dividend, and they're not expecting to earn more than a bond will get? I can get 7% from a Vietnamese government bond. Why would I invest in Tan Tao Group if it's only going to make me 5%? So what the main message that you have to remember, and I did mention this at least 1 week and probably 2 weeks in a row, when you're doing these capital investments, you remember I told you about the 3 alternatives I had to do at IBM with the 3 warehousing solutions, one at the airport, you remember that? And then one with the three places to put the computers around London, and then the business space all around the country. There were 3 alternatives, right? Take the different incremental cash flows between A and B, A and C, B and C, and I find that I choose the project with the highest net present value, positive net present value. We have a question on that later. Which question have I just been talking about? The overall wasted cost of capital. So you don't, the major message is this: don't discount some projects at the cost of debt and other projects at the cost of equity, because that's not fair. They should all be discounted at the same rate. You should have one discount rate. Now, sometimes I've seen it now in the book, 3 or 4 different books that I've read recently. Sometimes you get different people saying different things, and that you should use debt for some kind of projects and you should equity for equity. I think no. You stick to the rule that you use one cost of capital, which is the weighted average cost of capital of the firm. Unless there are special reasons why this is a very, very risky project, and even the cost of capital of the company is not properly evaluating the risks of the project. What kind of projects could you think of that would be very, very risky, where you might actually not want to use the weighted average cost of capital? Well, it depends on the industry. But for example, in the oil industry, in oil exploration, sometimes the costs are very, very high, and the risks, the probability of striking oil are quite low. You may want to classify that as an especially risky project, and you may want to discount the future cash flows at a higher rate than the cost of capital of the company, to take into consideration the extra risk of that particular one project. That if something is within your normal operations, you're a hotel chain, and you have one in Ho Chi Minh City, and you're thinking about opening a new hotel in Da Nang, then and if the choice is between Da Nang and Hai Phong, which isn't much of a tourist resort, but if you have maybe a business hotel in Hai Phong and a tourist hotel in Da Nang, there's two projects, then you would probably use the weighted average cost of capital of the company, because it's within your normal field of doing business, right? You know, maybe Hai Phong is more risky because there are more criminals in Hai Phong than there are in Da Nang. I don't know. No prejudice against the North. But you know what I mean. However, if that hotel company said, we think there's going to be oil under that piece of island which is being claimed by the Chinese, but we're going to take an oil rig, a hotel company, we're going to take an oil rig out there and start drilling for oil. We don't know much about oil drilling, but we think there's oil under that stuff where the Chinese are building a lighthouse. So we're going to do that. That's a pretty risky project for a hotel company, right? So they might want to put up a special high discount rate on that because of the extra risk. You get me? Okay. Where are we? Only halfway through the test now, aren't we? So anyway, the answer to question number 9 was A. If you use specific cost of debt and cost of capital, that would make the decision inconsistent. Is that right? Yeah. 9. Are we on 9? Or 10? 9. Well, have we already done that? Have we already done that? You're on 10 now, right? Why you have no mark? Hey. Where did you mark it? 9. Hey. Yeah. Oh, that's right. Number 10. Number 10. Yeah, this is a bit of a tricky one. 10 is B is correct. And I want to explain this because this is something I didn't properly explain. Remember when we did that weighted average cost of, when I got quite angry at you all? Remember? I think the coupon on the bond, remember that? It was 1/3. Oh, damn. 1/3, 2/3. This was 8%. 1 minus T, 25, and that was 12. 12%. No, it's the other way around. It was 1/3 and 2/3 debt. Debt, equity. Remember that? Remember that one where I showed you we had 1/3 of the company was equity, 2/3 was debt. It was, I think, 320 and 640. 1/3, 2/3. Remember? And I said that the cost of debt was 8%. And the tax rate was 25%. So the after-tax cost of debt was 6%. Right? And I asked you to calculate what is 2/3 of 6%, and you all quickly got the answer, which is 4%. Remember that?
Yes.
I was so much in awe of your mental arithmetic skills. And this one was very easy. 1/3 of 12% is also 4%. Right, correct. And 4 plus 4 equals 8. Cost of capital, weighted average cost of capital, 8%. I think some of the guys with the calculators got 7.92 because we were not rounding to the 3rd decimal point. Now, where I was a little bit not careful is I just said the cost of debt is 8%. And I think I quickly said it's got an 8% coupon, it's priced at par, which means its yield to maturity is 8. Yes? If you buy something at a new issue at par with a coupon of 8%, and it matures at par in 10 years. Its yield to maturity, you don't have to do any discounting. Its yield to maturity is also 8%. Right? Yes, say right, yes. Okay. Now, again in the book, there's a little bit of a difference of opinion about how to calculate the cost of debt. In different books that I have seen, they're both agreed about equity. When you're using the cost of equity, you have to use the market value, not what's in the accounts of the company. That's the book value, or the face amount of the stock. When you are calculating the cost of equity, you have to use the market value. Because share prices are changing, usually they're far, far different from what they are in the accounts. The market value of the company is usually a lot more than the book value of the company. You understand that, right? Yes? Yes? Okay. Book value is what you put in when you first issue 100 million shares at $10 each. So you've got a $1 billion company, $1,000 billion, $1 billion company. But that $10 you hope is going to go to $50 or $80 or whatever. Issue price is well, actually, not issue price. The face amount in the account is different from the issue price, and the issue price changes and becomes a market price. But what's the difference then between how you do the cost of capital for equity and the cost of capital for debt? The problem with debt is corporate debt, bonds issued by companies. They do trade a lot, quite a bit at the beginning, but the secondary market in corporate bonds is not very liquid. And so, in some books that I use, they say, so when you're calculating, you just use the you use the face amount of the bond, not the market value. Market value when you're calculating the cost for stock, you use the face amount if there's no market, and you have to use the coupon that's on the bond. So you have to assume that, which is not a bad assumption, they're going to have to reap whatever the price is, whatever the yield is, in a market which is not efficient. They're going to have to pay 8% every year on the face amount, and the value of that debt at the time. Therefore, you could take it par. So you could do it like I did it here, 640, 320 in equity, 640 in debt. But what this other book says, and that's what's the correct answer to this question, is that you should look at the yield to maturity of comparable outstanding bonds. So if there's, with similar credit ratings, you may have heard that bonds are given a credit rating, AAA. There are, I don't think, maybe there are 1 or 2 AAA rated companies now in the world. I used to know what they were, but I don't even know what they are now. There's 1 or 2. One might be Intel, I'm not sure, or Microsoft. don't think Apple has got any bonds outstanding. But somebody go onto Google. You've got your Google on. You're obviously not doing anywhere. You're doing Facebook or something. Go on AAA corporate bond. S&P AAA corporate bond, and see if we can get some companies, some company names. Probably only 2 or 3 in the world now. DuPont, not DuPont. A couple of pharmaceutical companies. Johnson & Johnson used to be AAA. But, you know, in the 70s and 80s when I was in the markets, there were a lot of AAA. General Motors was AAA. Ford was AAA. IBM was AAA. All these companies are now single A or even worse. But anyway, you look for a comparable 10-year with a similar rating. If there are none, you just go to you go back to what the other book says, and you use the book value of the company. It's probably easier. You might say there aren't any comparable companies that are trading. The secondary market in corporate bonds, short answer, is not very liquid. So you either use the coupon rate, which is question A, but the correct answer is answer number C, the yield to maturity. Question B in your book. B for question number 10. All right, question number 11. Correct answer is B. B. B for Barnes. Boston. Beetroot. Okay? And the question was, although debt is cheaper than equity, usually, there are some limits. If you keep borrowing, then the bank is going to say, we have lent too much money to this company. It's not going to be able to pay the interest. And once the banks start to worry about the company, then the financial risk of the firm may increase so much that the stock prices go down, the cost of borrowing in bonds go up, and all of a sudden that difference between cheap debt and a more expensive equity has gone. It's been arbitraged out. Okay, so what we're saying is there are risks to the amount of debt. In the theory, which I skipped over, more than 100 pages in most financial textbooks, they try to say that, according to something called Miller-Modigliani theory, that it doesn't matter how much debt you use or how much equity you use. That's irrelevant. The structure of capital, according to Miller-Modigliani, they got a Nobel Prize for this, believe it or not, but they said, and they proved it just through algebra, that how much debt you use and how much equity you use is irrelevant. Provided you make certain assumptions about the perfect capital market. No tax, no transactions cost. Everybody gets the same information at the same time. There's nobody who can dictate the price. Those are the 4 major assumptions underlying a perfect capital market. And clearly they're not. It doesn't help to have it. To me, I don't know why those guys got a Nobel Prize for showing that something is irrelevant based on inaccurate, unreliable assumptions. But maybe, I don't know why. Okay. So the answer to question 11B is the correct answer. I've said that already, yes? Just to repeat it one more time, because it's one of the most important things in this kind of section of finance about capital structure, is that although, as I said before, debt is cheaper than equity, it can't be, you can't borrow in practice, in the real world, you have a limit You can't use it 100% debt and $1 of equity from Michael Barnes. Because the financial risk of the firm just gets so high, and the people who are lending you this money get very nervous if there's not a healthy commitment by the shareholders. What they're looking for is the shareholders to put their own money into the company. It's a slightly different subject, but I teach a course on global business management, international business management. And we do a case study on the company Intel. Well, Intel was really started by two people, two engineers who were working for a company which made semiconductors in California. And they went along to a venture capital guy, and they said, we've got this concept of making semiconductors much smaller, carrying much more bits of information, and we know how to do this, and we're going to put I think it was $250,000 of their own money into the company. And of course now they're multi-billionaires. But they got the backing from venture capital because they were prepared to put their own money where their mouth is, to put their money where their mouth is, to commit their own money to the company. So the theory may say you can have as much debt as you like. In practice, in the real world, that is limited. A lot of investors nowadays will say, I like companies that don't have much debt. Which can fund their company with equity because they've been so profitable. But where do profits go when you're not paid in dividends? They'll go into the retained earnings of a company, right? So that's the best way of building equity in a company, is the profits which are reinvested in these positive net present value projects. Another message from I want to just summarize the messages from these quizzes, is that debt and equity do matter, but you shouldn't separate them. You should come up with a single weighted average cost of capital for using the discounted cash flow model to get the net present value. We said at the very beginning, the job of a finance manager is to maximize the value of the firm, not just to maximize the short-term profits in the accounts, but to maximize the value of the firm. That means the net present value of all future cash flows. So the job really is to choose those projects which add the greatest value to the company. So you can rank order them. Project 1 has got the highest net present value. Project 2, the next. As long as our net present value is a positive figure, it means that the returns are higher than the discount rate. Yes? If the net present value is 0, it means the returns are exactly equal to the cost of capital. Yes? Net present value is 0. That is the same as what's called the internal rate of return. Like with a bond. Yield to maturity is the internal rate of return. It's that interest rate which discounts all the cash flows back to the net present. You remember, you take 100 out of your pocket on day 1, and you get all this stuff back. And if you're discounting, if it's 8%, then you get 108 in 10 years' time. You discount that back, boom, 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 boom. You go back to 100. Net present value is 0 at 8%. Yes? Remember I said discounting is like compounding. Remember, I think on day one, I got you all to take out 100, multiply it by 1.15, multiply it by 1.15, 1.15, 1.15, 1.15, and then it was 200 after you've done it for 5 years. And if I ask you to divide 200 by 1.15 or 1.15, discounted, after 5 years, that 200 becomes 100. Internal rate of return 15%. Compounding up, discounting back. From the future to the present value. Okay. I know it's slow, but each of these questions is in the midterm, so don't lose focus. Don't forget these issues. Understand what I'm talking. If you still don't understand, it's okay. You better send me something and ask me to either repeat it or meet with you and explain it on the board or what. Okay? We've only got a couple more weeks. Next week we need to do. Now, up till now, we've been talking about the long-term capital, the debt and the equity. We've been talking about all these multiple year discounting cash flows, net present values. The last session we will do on what Miss V. Vi has been doing on working capital. That's all the kind of little stuff that, important stuff that financial managers can do with this year's money. This year's money, working capital, short term, everything within 1 year. But we're doing the big stuff now because it's actually more important to understand the long-term concept of the value of an asset is the present value of future cash flows. Forget about past cash flows, past dividends, past investments, past profits. The history is dead. Right. Okay. Question 12, the correct answer is B. B. The question was, capital budgeting is primarily concerned with A, capital formation in the economy, no, or B, evaluating investment alternatives, yes. Okay, question number 13. 13. The correct question answer is, I think it's B. Most people got that right? Okay. Here was the question. The question was, which of the following statements about the payback method is true? Either the payback method considers cash flows after the payback has been reached. That's not true. That's the opposite of the truth. The payback method doesn't consider cash flows after the payback, which is one of its weaknesses. So the correct answer is the payback method does not consider the time value of money. Answer B is correct. In the next question, A is correct. A is correct. If projects are mutually exclusive, you know, I talked to somebody about having mutually exclusive proposals of marriage. You can only accept one of them in most countries. Okay, so the definition, if projects are mutually exclusive, the selection of one alternative prevents the selection of others. You know, I think we had a picture of a boat and a bridge last time, right? You can only do one of these projects. In theory, theoretically, you could do both of them, but you only have enough money for one of them. So do you have a boat or a bridge to get across the river? Those are mutually exclusive alternatives. And the wrong answer, the wrong answer was the payback method should be used. It has nothing to do with it. Okay? Okay, question number 15. We'll take a break after we've finished the answers to the test. Question number 15. Answer A is correct. The internal rate of return must be greater than the cost of capital. A is correct. B, which is wrong, was the internal. It says a characteristic of capital budgeting. This is pretty basic, so please, girls, listen to me. If you don't understand this, you understand nothing about what I've been talking about for 3 weeks. What? Yes. I do want to finish, though, before it becomes a rush. Okay. Internal rate of return, for you to have a good project with a positive net present value, it must be kind of intuitively obvious. The internal rate of return must be greater than the cost. Yes?
Yes.
Okay, I will go on. Next question, the answer to the next question is 16. B is the correct answer. What I said was with non-mutually exclusive projects, that means when you've got a lot of projects that you want to do that you can do, then you should